Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's very important webinar organized by WSP of ICL. It is my proud privilege to share with you today we are organizing 72nd CP program in this year. We are organizing on various emerging topics relating to the audit. And today we are going to organize this webinar on CARO and amendments in revised Schedule 3. That is a demystifying enhanced financial reporting disclosures. In order to tackle this very important topic, we are having with us two eminent speakers, CA Dr. Alok Gargji and our past Central Council member, CA Sanjay Vasudevaji. So on behalf of AASP of ICI, I welcome both of you, sir. Welcome past Central Council member, CA Sanjay Vasudevaji. Welcome today's speaker, CA Alok Gargji. Welcome to you, sir. It is my proud privilege to share with you the brief profile of our today's keynote speaker, CA Sanjay Vasudevaji. CA Sanjay Vasudevaji is currently the managing partner of Messer SCB and Company LLP, earlier known as SC Vasudeva and Company. He has an experience of more than 25 years in the accounting profession in areas ranging from statutory audit, internal audit, Companies Act, and FEMA. He has, over the years, worked with the clients across the country and he has served various clients across the country in different sectors, including manufacturing services, banking, and finance. He has wide exposure to auditing and accounting standards, including Ind AS, having been involved in the formulation of such standards, their practical application, as well as overseeing their implementation. He was an elected member of the Central Council of the Institute of Chartered Accountant of India, and from the year 2016 to 2019, and served as various committees of Institute during such tenure, including FRRB as a chairman, as well as the vice chairman of Auditing and Assurance Standard Board of Institute of Chartered Accountant, and the Ind AS Implementation Committee, and vice chairman of the Digital Accounting and Assurance Board, DAR. He is currently a member of Corporate Law and Governance Committee, as well as the National Committee on Financial Reporting 2020-21 and the National Executive Committee of FICCI. He is currently in a government body of the Foundation for the Audit Quality, FAQ, as well as he is also a co-opted member of the Auditing and Assurance Standard Board of Institute of Chartered Accountant of India. As far as his past positions, he was a member of Data Analytics Working Group, DAWG of IFAC. He was a technical advisor of the International Auditing and Assurance Standard Board, a member of the Committee on the Auditing Standard and Quality Control of South Asian Federation of Accountants, SAFA, as well as the co-opted member of the Accounting Standard Board, the Auditing and Assurance Standard Board, as well as the Research Committee and Expert Advisory Committee of the Institute of Chartered Accountant. He was the member of Quality Review Board set up under the Section 228A of the Chartered Accountants Act 1949, and he was the president of the Board of Governors of the Delhi chapter of the Institute of Internal Auditors, Florida. He was speaker. Presently is a speaker on various seminars and conferences organized by Institute of Chartered Accountant, various regional councils, various branches, various chapters, and as well as the Chamber of Commerce on various emerging topics on audit, accounting, corporate law, and India. Since still the list is very vast and very long, so it is my proud privilege, sir, to share the brief profile among all the members, sir. Welcome you, sir, in this today's 72nd CP program organized by AASP of ICI. So I request, sir, for your keynote address, and I request you, sir, to please enlighten with your words of wisdom, sir. Over to you, Sanjay, sir, please. Sir, you are not audible.
Thank you very much, Anilji. Am I audible now?
Yes, sir. Yes.
My heartfelt thanks to the AASB, Chairman AASB, Dr. Sanjeev Singhal, Vice Chairman Ms. Doshi, my fellow speaker, Dr. Alok Garg, Anilji, other Secretariat members, dear members, a very good afternoon to all of you. Thank you, Anilji, for your kind words, for inviting me here for this very, very important webinar. Very, very happy to be here and share my thoughts. It would have been great if the chairman and vice chairman were there, because we spent a lot of time in developing the guidance note and their deliberations would have been, their presence would have been very useful. I'm sure you will take back these thoughts to them. So what I would be speaking on today is just to give a perspective about what my thoughts are about CARO, how it perhaps strengthens the governance process, as well as puts in more responsibilities on the auditor, as well as the preparers of financial statements. I will not be going into clause by clause because I think Dr. Lok Garg would be doing that. So essentially, if you look at the, just a brief introduction, then and look at the background or the backdrop in which this has come up. We have seen number of corporate scandals. We've seen scams. We've looked at various bank frauds which have taken place, and obviously there's been some learning from that. And regulators have studied what has happened in terms of diversion of funds, in terms of non-performing assets, insolvency proceedings, evergreening of accounts, related party transactions, frauds coming to light. And so they have, in their wisdom, thought about bringing in these changes to, strengthen the governance process in financial reporting. So this is broadly the backdrop. And if you go through the changes, you'll see each and every aspect, is actually mirroring, or is actually coming in response to something which has happened. I know, Alokji would be taking you through the history of CARO, right from CARO and all. So essentially, CARO or CARO has been, asking auditors for additional responsibilities, additional reporting, which may or may not be forming part of the, audit responsibility per se, as per the auditing standards. But here, this has gone a notch, maybe not even one step, maybe 2-3 notches higher. And that's what we will just try to understand. And so in response to that, the notification was done by the MCA in consultation with NFRA, and the notification was done, for bringing in CARO to improve the governance process and to strengthen financial reporting. The earlier applicable date was for the financial year 1920, but that was extended by virtue of 2 notifications. It was then made mandatory for 21-22, and meantime the changes in Schedule 3 were also brought in. So this was the background, and so as I mentioned, the CARO reporting requirement is supplemental to the main audit reporting requirement under 143, and as opposed to 143 1, 2, and 3 subsections. Subsection 11 applies to a certain class of companies, and I'm sure Alokji will be taking you through what is exempted. Based on the turnover, the capital and borrowing threshold. So this is something which we need to bear in mind. Now, very quickly going through some of the changes. I very quickly, for instance, on so some clauses have been modified. So there's been some addition. There have been new clauses which have been added. For instance, now on assets other than PP, you also require maintenance of proper records on intangible assets. There's a requirement for looking at revaluation by registered value and also reporting if it is in excess of 10%. There's a requirement for assessing the procedures of verification carried out by companies, and if there is a variation of 10% and all, that has to be reported by the auditor. In terms of Benami transactions, then unaccounted income, which is brought forth, frauds on. So there's a huge change as far as frauds, whistleblower complaints. Then in terms of working capital limits where returns have been furnished, the auditors need to compare that with the books of account. The company also needs to report that. That's another change. Looking at internal audit, so this has been brought back. This clause, incidentally, has been brought back in terms of looking at the assessing the internal audit process in the company. It used to be there earlier. Additionally, there's a requirement now to also look at the internal audit reports. So that is a specific requirement that the auditor has to look at internal audit reports. Whistleblower complaints I've mentioned. Then there's a requirement for cash losses. It used to be there earlier. That was linked to a certain aspect, whether the company will be referred to BIFR or not, but it is now retained only with regard to cash losses. Resignation of auditors, though covered under our code of ethics and though covered under the Companies Act, now also in CARO, one needs to report whether we have, the auditors, incoming auditors have considered the report. And also a very, very important clause with regard to assessment of the ability of the company to repay its liabilities, based on financial ratios and all. So these are some far-reaching changes. Then also on Schedule 3, you have the mentioning of cryptocurrency. You have requirements on the intermediaries, whether you are giving out loans or receiving loans, or giving out funds or receiving funds. And that again has to be mentioned in the main audit report also. So a lot of this has been aligned. Essentially, what has happened is that the requirement for reporting has been kept on the company as far as Schedule 3 is concerned, and the auditor's responsibilities for reporting under CARO. So both these things have, happened in response to, the requirements of the regulators in the society in improving, governance, the corporate governance practice. Now, so let's just go into some of the themes and what changes and what does not change. So essentially, what is clear and which has also been mentioned, and let me before that just pause and say that the AASB has done a commendable job in bringing out a guidance note. They brought out a guidance note earlier also, and the 220 guidance note has been amended after the Schedule 3, amendments. The Schedule 3 was, the changes were notified. So I think that's a very, very useful piece of guidance which is available to the auditors. So just coming back to the aspect about what does not change now, and which is also mentioned in the guidance note, that this is an audit, it's not an investigation. The auditor is not required to really go and investigate. However, the procedures some of them have been enhanced. For instance, in case of your normal audit process, you will be following the auditing standards, which you will continue to do. But just two instances which came to my mind in terms of how it will be slightly different. For instance, in the case of internal audit, what we are looking at as auditors is you are taking the evaluation of the internal audit process as you are looking at the internal control environment in totality. But here you are specifically required to look at the internal audit system, whether it's commensurate with the size and nature of the business of the company. Secondly, you are asked to look at the internal audit reports also. So there's an additional procedure which needs to be carried out. Then again, in the case of, let's say, movable property title deeds, as auditors, you will carry out your assertion, you do your risk assessment, but to again report on the aspects where the title deeds are not there is an additional enhanced procedure which the auditors will need to carry out. So this is in keeping in line with the CARO, which has been there earlier also, certain enhanced procedures. So the important part here is that these procedures need to be dovetailed into the auditor's main audit process only. It should not form, it should not be in addition to what you're doing as an audit. It should not be done towards the end. Otherwise, there will be a lot of challenges to ensure compliance. So from that is one aspect which one needs to look at. Then, obviously, in carrying with the spirit, enhance professional skepticism. A lot of these, queries which are there as far as the audit is concerned for CARO require auditors to engage with the auditee, inquire from them. For instance, intercompany loans, intermediaries, related party transactions. Now, the auditors need to understand that these are not merely on the basis of representation that the auditee is given. You need to go beyond that. You need to first test out those representations and not really rely on this and do your own check. So an enhanced degree of professional skepticism is very, very is extremely warranted. Then some of the aspects require specialized. So you have the Benami properties requirement, the Prohibition Act. There you will require your teams to be at least well versed in some basic aspects about the Benami property law, the income tax laws, the various requirements under SEBI, the whistleblower laws. So you need to upgrade your skills. You also need to upgrade skills of your audit teams. So that's again something which is very important. Also, because of the uh, increased interaction with the auditee in getting or obtaining information. For instance, as I mentioned, auditors need to report on the wherever working capital limits have been taken by companies in terms of comparison of books of account and the returns which have been filed. You need to look at the physical verification which has been carried out. You need to look at the revaluation. No, so these cannot be done, or assessment of the ability of the company to repay its financial liabilities. Now, this cannot be done towards the end of the audit. There has to be a planning which has to be done. A communication has to be given to the auditee. You need to engage with the auditee, make them understand what is the requirement. Certain disclosures will require. So it has to be a more engaged audit process, and your documentation also has to speak accordingly. So this is something which the auditors really need to take into account. An important aspect which we take into account in audit is the principle of materiality. Now, the guidance notes does say that the principle of materiality and test check can be applied by the auditor when you're reporting under CARO also. But then there are certain specific items whereby you need to report. For instance, reporting on discrepancies in excess of 10% when on physical verification, or 10% threshold is there as far as revaluation is concerned. So these are also aspects which perhaps go beyond materiality. So one, the auditors need to recognize and understand that, as I had mentioned, there could be enhanced procedures, but you have to dovetail this into your audit process. And how do you see that these errors are appearing and they are reported properly? So that is something which one needs to take into account. Then another important aspect as far as the adverse comments of the subsidiary company and their auditors are concerned, there is no ambiguity. There is no room for materiality. Whatever is coming in from there has to be reported. So again, so there is a difference as far as the normal audit process for materiality is concerned and for CARO is concerned. Now, a very, very important aspect of this, which CARO has had, and again, when I said that it, raises a couple of notches higher, is exercise of professional judgment. Now, there are requirements from the in CARO, the queries whereby you have to assess with regard to the procedure and coverage of physical verification followed by the management. Is it appropriate or not? Then also the analysis or assessment of whether the company will be able to repay its financial liabilities in the next 1 year or not, based on financial ratios, management plans, board of directors. Now, this requires a understanding about the business of the company, an analysis, a discussion, a documentation, understanding what is going to happen. So it cannot be done merely on the basis of management representations. So the auditors have to perform, have to take a professional judgment, and in doing that, they also need to be aware that tomorrow they cannot be faulted if they followed the principle of due care, and they have actually followed the process which is laid down, because a lot of this is subjective. Now, you may, as at the balance sheet date, assess that the company is able to meet its financial liabilities. Tomorrow, if it is not, then there should not be somebody coming to you and saying that this is what you had said. So that is based on the assessment done on us that day, the procedures which were carried out. So it's very important to, one, understand the requirement, limit what is available, what is not available, and then to take a view and to document that. So I think this is fundamentally very important as far as the aspect of professional judgment is concerned. And I cannot re-emphasize the need for auditors to be very, very careful in taking information, analyzing it, and then forming their judgment. So here you are going perhaps even beyond the auditing standard of 570 going concern in actually. So it should not be that you are certifying that the company is good, to pay off its liabilities in future. That's not the way it should be. The other aspect, which also, as far as reporting and is connected here, and I mentioned is, and again, I'm saying at sometimes, and I'm trying to link with some of the reviews which we did as far as the FRRB is concerned. A lot of times the auditors used to mention that, based on the information explanations given to us. Now, the reporting has to be done by the auditor. You can take representation, but you also have to demonstrate that you have done your own audit tests and checks and balances have been done. So it's very important, especially in such cases, to document that and also to articulate that in the audit report. So that is the other aspect I want to mention. The other theme which is continuing and which again gets enhanced is the, as an auditor, earlier you were being asked to comment on certain things. But here you are providing a warning or a forewarning on the future. So the case in point is what I just now mentioned about the company not being able to meet its liability. Now here you're providing a guidance that, okay, based on this, the company may not be able to. Then there's aspect on fraud, whistleblower, internal auditor, looking at the internal audit, related party transactions, whether funds have been diverted or not, whether they're being used for the purpose or not, short-term funds being used for long-term, whether you provided funds, to your subsidiary or given a guarantee. Now, these are all indicators of things which can go wrong in future and which have gone wrong in the past. So what MCA or the regulator is saying that as an auditor, so they've even asked the company to specify, but as an auditor, I need to keep on assessing that at every level, or even resignation for that matter. That if you are coming in as an auditor and you are coming in the after somebody has resigned, have you actually looked at if there had any concerns, which they could not report. So I think this is a very, very clear theme and a message to auditors that look, we are expecting you to give us a signal of anything which is going to go wrong. And that's again where we need to really, really step up. Another important aspect which perhaps has not been considered is the interplay between audit and accounting also, as far as CARO is concerned. I'll give you a case in point. Now, there is a requirement that if there is income which was not disclosed earlier and the assessee or the company has surrendered, now it has to be accounted for, and auditor has to mention that whether it has been accounted for, in the properly or not. Now, this from an accounting perspective could lead to certain challenges under the gap where you have the accounting standards notified. You will take it under AS5. It could be a prior period item, or it could, you will disclose it as, not an extra, but profit and loss from ordinary activity. But under the Ind AS environment, you will have to perhaps restate your balance sheet. Now, if that happens, would it invite the MCA to ask the companies to reopen their books under 131? Now, so this is a very, very important aspect which perhaps also auditors need to look at. Then arising out of this is the aspect about reassessing your internal controls. That okay, this income escaped assessment is the internal control environment in which you are today conducting the audit. Is that in order? Are there any challenges there? Do you need to reassess your risks? Do you need to carry out certain additional processes? How do you link it to your opinion in the main audit report? So again, these are some of the things which I thought I should mention. Now, as far as Schedule 3 and CARO is concerned, so there are certain aspects which the company has to disclose and the auditor also has to comment in CARO. And in all probability, the company would be making those disclosures. The challenge will come if the company does not make disclosures or they make inadequate disclosures. Now, it will not, that is not going to drive as to what the auditor has to report in CARO. Secondly, how will that impact your main audit report? Because you have to give a true and fair view. So if such a disclosure on, let's say, related party transactions or any of the new Schedule 3 disclosures really impacts the true and fair view, then the auditor may need to qualify the main audit report. So that is another aspect which one needs to bear in mind. As far as the consolidated, the CARO consolidated is concerned, the
I hope some network issue.
Yes, he is not audible.
Sir is not available. Na? I hope some network issue, sir. Sir, you are there? I hope sir is not there. Mr. Parth, sir is not there, I hope. Hmm. I hope due to the network issue, I got disconnected. So let's wait for 10-15 seconds. Otherwise, Alok sir, we will start. Let's wait for 10-15 minutes, 10-15 seconds. Sir has rejoined.
Sorry. There was some power issue. Anilji, my apologies. Just
Yes,
got
yes.
logged out. So I think I was on the interplay of audit and accounting, and then I talked about Schedule 3 vis-a-vis, CARO 2020, and there I was saying that the companies will be required to make the disclosures, and the auditor will also need to report on certain clauses. However, if the company has not made the disclosures, the auditor still has to report under CARO. So there is no correct. But yes, if there is an inadequate disclosure or the disclosure has not been made by a company in respect of the specific law, and I'm sure Alokji will also cover that, then the auditor will need to see if they need to look at their main audit report in terms of modifying their main audit report. So that was the aspect where I was when I got locked off. The other aspect was on the consolidated, financial statements as far as CARO reporting is concerned. The requirement is only for auditors to pick up the adverse comments or the qualifications from the subsidiary accounts and then report the details of the subsidiaries as well as the clause number. So there is no other requirement as far as consolidation of CARO report is concerned. As far as another important on period of compliance, the CARO is applicable as at the so you are reporting as at the balance sheet date, but you have to look at the compliance for the full year. So it doesn't mean that if in respect of, let's say, a transaction where there is a loan which has been given or not repaid, or an aspect of there's a default or there's a non-compliance of a law, if there is a non-compliance during the year and the compliance has been done at the year end, does not mean that the reporting does not need to be done. So these were some of the thoughts which I had as far as the theme is concerned. Just to sum up, I just like to reiterate that the regulators, the MCA, the government have responded to events which happened, and they have brought forth the changes to improve the quality of financial reporting and corporate governance. I think it's now upon us to really take responsibility, to really understand the requirements in letter and spirit, where we're required to upgrade or skill in terms of knowledge, to modify the audit procedures, to have an enhanced degree of skepticism, to also ensure that they are asking the right questions, asking the right queries, not only relying on manual representations, carrying out the right tests, and then documenting it properly to ensure compliance of the various provisions. And I think it also gives an opportunity to auditors today to really have this leap of faith. in terms of ensuring that, okay, this is the expectation of the regulators, and we can definitely come up to the level and deliver. So that in that respect, I think the institute has really been, really going ahead and coming out with guidance, having these webinars, in educating the members, and I'm sure with the level of commitment that our members have, we'll be definitely able to rise to the occasion and really rise up to the occasion and ensure that as auditors we are able to contribute in the whole governance, improving the governance process and ensuring better quality financial reporting. At the same time, I think as auditors, or maybe at the institute also, we need to look back and see that are there aspects from an auditing perspective, from an audit procedure perspective, that we need to change, we need to anticipate in future, because right now we are responding to what the regulators are asking us to do. But are there aspects on which we need to take the lead and bring out guidance, bring out, educate the members that these are aspects on which we also need to carry out, reporting in the future. So those are some of the thoughts which I had as far as the CARO is concerned, from a I would say from a 360, not from a 360 degree, but from a from a height of 35,000 feet. I know, Alokji, you would be looking at it more intricately. I do have a couple of thoughts on specific clauses which I will leave with you, and perhaps if possible you can address it. One on the, now that the if you permit, Anilji, can I do that?
Yes.
Can I just leave some thoughts
Yes.
with Alokji? So one on the fraud. So now that the reporting under fraud has been enhanced, so earlier it used to be employees and officers of the company. Now it will also involve so that has now been removed. One would be the cybersecurity attacks which are happening. Would they also fall within the purview of fraud? My sense is that it is possible that even if it is done by hackers, one will need to report that. Second, how do we now distinguish fraud, whether taking over expenses by employees, not following tax laws, TDS deductions, or even for that matter the the income tax assessments, agreeing to income which escaped assessment earlier and surrendering that income. Would that tantamount to fraud? That's one concern which I had. Then in terms of CIC within a group, now if you are so you need to identify how many CICs are. Now if there are subsidiaries, there are others, as you don't have access to those information, how can an auditor really look at this aspect effectively? Then, so these are some of the thoughts which I had on specific queries. But thank you very much to AASB and Anilji for inviting me to share my thoughts. I know I have perhaps given a different perspective. I hope the members find it useful, or I've not looked at specific. These are my thoughts. I think I looked at these from a perspective, and I thought this would perhaps give a different perspective and also motivate our members to really comply with CARO. But happy to take any question later on, and I'm sure Alokji will be looking at it in more detail. Thank you once again. Namaste.
Thank you, sir. Thank you so much, sir. Thank you so much for sparing your valuable time and enlightening all of us on various entities on CARO and Schedule 3 in a very nutshell manner, from all 365 degrees, 360 degrees, by the way of this. Sir, thank you so much, sir, for sparing your valuable time. And once again, thank you so much, sir. So if you permit, can we start the technical session with Alokji, sir?
Please. Unless there is any specific queries which somebody has, I don't think, but that's okay then. Alokji can take it. Fine. So I'll be here for some time and then I will exit.
Yes.
All the best, Alokji. Thank you very much. I hope I'm not intruded into your time too much.
Thank you so much, sir.
Thank you.
Thank you so much.
Thank you, sir. Thank you, sir. Now we are having with us C. Alok Gargji to tackle this today's technical session on CARO and Schedule 3. And Alok ji, I would like to share with all of you the brief profile of Alok Gargji, Dr. Alok Gargji. He has completed his graduation BCom honors from Delhi University. Is a qualified chartered accountant, All India top 3 score in accountancy in 2007. Is a qualified company secretary in 2008. Diploma holder in IFRS from Akka, London, United Kingdom in 2015. Certified Ind AS from the Institute of Chartered Accountants of India in 2013 and completed certificate course on BRSR from ICAI in 2021. As far as his association and deliberation and experiences are concerned, he is a prolific speaker, delivered more than 700 lectures, including overseas deliberation in Dubai and Nepal, and at various platforms in India organized by the various universities, various committees of ICI branches, study chapters, and study circles of Institute of Chartered Accountants of India. He has been awarded with the National Education Leadership Award from Delhi University in association with the Indian Accounting Association, and is a visiting faculty of Institute of Chartered Accountants of India for the certificate course on Ind AS, and is a visiting faculty of Delhi University and University of Udaipur in diploma on IFRS. Is a special invite to the Accounting Standard Board of Institute for the financial year 2019 to 20 and 20 to 21. Is a nominated member on the board of Managing Committee of IFRS for Delhi University. Is a special invitee for the Board of Studies of Institute of Chartered Accountants on various initiatives on financial reporting. He has delivered session on Ind AS to the public sector employees organized by SCOPE, Department of Public Enterprise, Ministry of Heavy Industries, NIFM, Ministry of Finance, ICI, SA, and CAG of India. Is an awarded the subject matter expert for the IFRS session on HSBC and Bharti Group, and is a founder of IFRS Ind AS doses and initiative as a contribute towards awareness on IFRS and Ind AS to more than 10,000 professionals across India. He is having relevant experience in the field of financial reporting, consolidation, auditing for the more than 15 years in the multinational Indian corporate and CA firms. Currently working as a general manager finance, heading financial reporting, consolidating, and capex vertical of the large listed company. As far as his publications are concerned, he has authored various publications. Recently, authored the comprehensive book on Schedule 3, treatise on the Schedule 3, a guide for the preparation of financial statement, published by the Bharat Law House. He has also authored a comprehensive book on Ind AS, on treatise on the Ind AS, has co-authored a comprehensive book on leases, treatise on leases, and co-authored a comprehensive book on Ind AS as insight to the Indian accounting standard, as well as developed material on Ind AS and IFRS for CA Final new scheme of Institute of Chartered Accountant, and review material of the Bhutanese accounting standard drafted by the Bhutan on behalf of the Institute of Chartered Accountant, and authored numerous articles on IFRS and Ind AS as in the newsletter and the magazines of ICI. Still, list is very long. So once again, I welcome you, Alok ji, and sparing your valuable time. Thank you so much for acceding to our request. Now I request Alok ji to deliberate on this topic. Over to Alok ji, please.
Thank you, Anil ji, for this detailed introduction, and thank you, AASB, specifically Chairman sir and Vice Chairman sir, for giving me this opportunity to deliberate on CARO and Schedule 3. And having Sanjay Vasudeva sir, who is himself is like an authority on this topic, so it's a matter of pride and privilege for me. And thank you so much, sir. I think he has beautifully covered in 25 to 30 minutes. He has beautifully covered this entire universe of CARO and Schedule 3. So, Anil ji, please confirm if my PPT is visible.
Yes, sir.
Yeah.
Fine, sir. Make it full screen, sir. Yes, sir. Fine.
Yeah, I think it is visible now, right?
Yes, sir.
And am I loud and clear?
Yes, sir. Fine.
Yeah. So, good afternoon, all the audience. And of course, today we are going to discuss about CARO and amendments to Schedule 3. And this is a high time, and I would say this is a very important topic to discuss on these aspects, from preparation of financial statement as well as audit of financial statement, right? So I would say when I ask a question from the participants or from audience, that Schedule 3 is responsibility of whom? Is it a management or is it an auditor? So technically speaking, preparation of financial statement is the responsibility of the management. But auditing the financial statement and providing an opinion on the financial statement is the responsibility of the auditor, right? If the management is not complying with the provisions as per the regulatory framework, for example, if the management is not complying with the requirement of Schedule 3, if the management is not complying with the requirement of accounting standards, so it is the auditor who will talk about these non-compliances and who will disclose the qualification in its report that the management is not complying with the regulatory framework, regulatory requirement of the standards or accounting standards. So technically speaking, Schedule 3 is not only the responsibility of the management to execute the requirements of Schedule 3 is the responsibility of the management, but to audit and to ensure whether it is in compliance with the requirement of Schedule 3, it is the responsibility of the auditor as well. So it's not like it's a one-sided responsibility, it's a dual responsibility. Client, I mean to say management, as well as an auditor. And I would say that even if a management is not complying with the requirement of Schedule 3, this may tend to amount to a misstatement under Standard on Auditing 450, SA 450. And if there is a misstatement, the auditor is required to disclose this fact in its audit report as well. Now, the second aspect is CARO. So like Schedule 3 talks about the preparation of financial statement, it prescribes the format of financial statement, right? CARO under section 143 subsection 11 of Companies Act 2013, CARO is like a weapon on which the auditor has to report on certain clauses regarding the management, regarding the company's affairs, right? So let's discuss the history of the CARO. Let's discuss the journey of the CARO and Schedule 3. And then I will discuss each and every clause of CARO. And I will discuss the related amendments in Schedule 3 in line with the CARO, where auditor has to put its all the best efforts to ensure that the compliance should be at its peak, right? So starting from the CARO, in 1988, Mao CARO was introduced. And at that point of time, there was 27 clauses. At that point of time, there was 27 clauses. Okay. After that, in 2003, after 25 years, rather I would say after 15 years, this CARO got revised, and in CARO 2003, there was 21 clauses, right? In CARO 2015, there were 12 clauses. In CARO 2016, there were 16 clauses. So in 16, it was 16 clauses. And recently, on 25th February 2020, this CARO 2020 got notified, and it is an amended CARO, which is having a 21 clauses, right? If I talk about CARO 2020, it is having a 21 clauses. And you know, there is a similarity in this CARO 2020. There is a consistency in this CARO 2020. And what is the consistency? Moving from CARO 2016 16 clauses to 21 clauses. So one clause has been deleted, right? So the clause was regarding the compliance of section 197 or 198 of the Companies Act regarding the managerial remuneration has been deleted. Why? Because it is already covered in the main audit report, right? So there is no need to cover that aspect in CARO as well. So one has been deleted. So now there are only 21 clauses in this CARO. Okay. So in this 21 clauses, this 21 clauses has been bifurcated into three parts. 7 clauses is those clauses which have been inserted as a new clauses, right? So 7 clauses are new clauses, altogether completely new. Okay. 7 clauses are there where there was existing clauses in CARO 2016, but those existing clauses have been modified. So when I talk about these 7 are those where it has been modified. 7 clauses, the remaining 7, it is remained constant, no change. 7 clauses, no change, right? So 7 3s are 21. 7 clauses are new clauses. 7 clauses are modified clauses. There are some modifications, some amendments in the existing clauses, and there are 7 clauses where there is no change, right? For example, if I talk about new clauses, for example, resignation of auditor, this is altogether a new clause, right? If I'm talking about the incurred cash losses of the company, this is altogether a new clause. If I'll talk about internal audit system, right, which Sanjay Vasudeva sir was also mentioning, this clause is altogether a new clause, right? Although this clause was there in CARO 2003, and again it is reintroduced in CARO 2021, right? If I talk about if I talk about undisclosed or unaccounted income, this is altogether a new clause, right? So auditor has to report on all these new clauses, and these are the new clauses where the efforts are required from the auditor side as well as from the management side to ensure the accurate and proper compliance for this year, right? 7 clauses are modified clauses. When I say modified clauses, for example, in case of property, plant and equipment, right? So what was the clauses? The clauses was, first, whether the proper records with respect to particulars of fixed assets have been maintained or not. So it was talking about fixed asset register. So this clause is still there. The second one was whether the physical verification of the fixed asset has been conducted at regular intervals or not. If there are material discrepancy, it has to be reported, right? So these clauses were there. Whether the title deeds of immovable properties is, which is in the name of the company, whether it is in the name of the company or not, right? These were the 4 clauses which were there in 2016 as well. When I'm talking about CARO 2020, this first clause, clause 3, subclause 1, has been modified to cater some additional requirements as well. For example, this clause 3, subclause 1 also talks about intangible assets, right? Now you have to, now as an auditor, you have to see, you have to audit and you have to comment on whether the particulars of intangible assets have been properly maintained or not, right? For example, there are software. So these software are lying on which hardware, right? For example, there is ERP system, server. So where the server is located, right? All the particulars regarding gross carrying value, your accumulated amortization, your net carrying value, your particulars of intangible assets, date of capitalization, all these things like intangible asset register has to be maintained properly. So this is a new requirement under clause 3, subclause 1. Second, for example, there is a Benami property. So regarding the Benami property, there is again a new requirement, right? There is again a new requirement that if there is a Benami property, the auditor has to comment on what are the details of those Benami properties. So auditor has to comment on these disclosures, right? The third could be if the company has carried through a revaluation, if the company has carried a revaluation exercise, right? And if there is a net carrying value is more than or equal to 10% due to such revaluation, auditor has to comment on this thing in its audit report in terms of CARO, right? Now coming to schedule 3, and then I will relate CARO as well as schedule 3, right, in the next 1 hour. So if I talk about schedule 3, so schedule 3 talks about the preparation of financial statement. CARO is something which talks about the comment on the financial statement, right? It is a weapon of the auditor, right? And financial statement is the property of the management. Am I right? So officially, to financial statement management ki property hai na? Okay. Yeah. So coming to the format of financial statement, prior to 2011, Schedule 6 was there, and Schedule 6 of the Companies Act 1956 talks about the format of the financial statement, right? And at that point of time, there was a talks in the news that India has to implement Ind AS. India has to implement IFRS, right? So when India was about to implement Ind AS or IFRS, the regulators, or let's say the lawmakers, or the people sitting at ICI level, they have realized that before implementing this Ind AS or IFRS, we need to align our format of financial statement. So on 25th February 2011, 35 Ind AS were notified. If my memory is correct, 35 Ind AS were notified, and after 72 hours on 28th February 2011, these standards were deferred sine die. And on 28th February 2011, this Schedule 6 was revised, and a notification regarding revised Schedule 6 came, where the concept of current and non-current classification was there, right? So the idea and objective was, first and foremost objective was to align the financial statement of the companies, right? So this current and non-current classification format was applicable from 1st April 2011, right? Lot of things were under progress, and this Companies Act was on the verge of changes or verge of amendment, right? So Companies Act 2013 was notified on 1st April 2014 with effect from 1st April 2014, and on 26th March 2014, Schedule 3 was notified effective from 1st April 2014. 26 March 2014, on 26 March 2014, the Schedule 3 was notified, right? After this date, on 16 February 2015, government has notified 39 Indian accounting standard. Now, India INC had two set of standards. I'm talking about corporate clients. I'm talking about corporate world. I'm not talking about non-corporate entities. So India INC has accounting standard as a one set of standard, which is old standard, and Indian accounting standard converged with international financial reporting standard as another set of standard, right? And technically speaking, we had 27 accounting standard vis-a-vis we had 39 Indian accounting standard, right? And the structure of this Indian accounting standard is quite different from the accounting standard in terms of guidance, in terms of disclosure, in terms of nomenclature, in terms of accounting treatment, in terms of presentation, in terms of component of financial statement as well, right? So after introduction of Ind AS on 16 February 2015, and these new set of Indian accounting standard was applicable to the listed companies and other companies which is covered under the threshold or roadmap criteria from 1617 on a mandatory basis from 1617. Now there was two asks, either to revise this Schedule 3, which was notified on 26 March 2014, or to develop or to notify a new Schedule 3, right? Then government has decided to develop a new Schedule 3 for the companies which are applying Indian accounting standard. With this objective, on 6 April 2016, there was an amendment and there was a notification on Schedule 3, and which says that the initial 6-7 line says that the earlier Schedule 3, which was notified on 26 March 2014, will be continue to be nomenclated as a Division 1 to Schedule 3, right? And this Schedule 3 is applicable to the companies which are preparing their financial statement as per accounting standard notified under Companies AS Rules 2006. But now it is not 2006. Now it is Companies AS Rules 2021, right? So 2006 is not correct as of now when I'm speaking today, right? So then the notification says whatever we are giving below to this is altogether a new Schedule 3, which is known as a Division 2 to Schedule 3. And this Division 2 to Schedule 3 is applicable for the companies which are applying Indian accounting standard, right? Okay. Then on 11 October 2018, then after 16 February 2015, on 6 April 2016, this Schedule 3 Division 2 was notified. Then on 30th March 2016, the roadmap for implementation of Ind AS on NBFC companies was decided. And on NBFC companies, Ind AS was made applicable from 2018-19, right? Then on 11 October 2018, as you know, the business structure, the kind of activities NBFC companies used to perform, it is quite different from the normal companies, right? When I say normal companies, I mean to say other than NBFC companies, right? So again, there was a need to issue a guidance regarding the format of the financial statement for NBFC companies, and it is a quite different format, right? So with this, on 11 October 2018, there was an amendment in Division 1 and Division 2 to Schedule 3, and Division 3 to Schedule 3 was notified, and Division 3 to Schedule 3 was made applicable from was made applicable to the companies, to the NBFC companies which are applying Indian accounting standard, right? So far we are having two set of accounting standard, AS and Ind AS. So far we are having three Schedule 3, Division 1 to Schedule 3, Division 2 to Schedule 3, and Division 3 to Schedule 3, right? So 11 October 2018, Division 3 to Schedule 3. Now the history and background is still not over. since a lot of scams were happening, the frauds were happening, and for the government, the auditor or a chartered accountant is the most important, or I would say most responsible person. He is like a financial doctor. He is like a person who is commenting on the financial health of the company. He is commenting on the financial viability of the company. He is commenting on the financial conduct of the company. He is commenting on the he is commenting on the governance of the company, right? And chartered accountant or statutory auditor seems to be an independent person, right? So government has decided to enhance the responsibility of the chartered accountant as a statutory auditor. And with this, on 25th February 2020, on 25th February 2020, just 28 days before the national lockdown, on 25th February 2020, government has notified CARO 2020, right, with some stringent amendments, with some new insertion of clauses, with some modification, and with retaining some of the old clauses, right? So this was the government objective when government had notified this CARO 2020 on 25th February 2020. Now, this 25th February 2020 CARO has been deferred by 1 year. Earlier, it was supposed to be made applicable from the year 2021. Now it is made applicable from 21-22. When I say 21-22, I would like to say that the auditor's report on the financial statement for period ending 21-22, for the period 21-22, this CARO 2020 is applicable. Now, when I used to ask this question, why this CARO got deferred, so many participants says that this CARO got deferred because after 28 days, there was a national lockdown. So due to COVID, CARO get deferred. So let me tell you an honest answer. It was not COVID who was the culprit. If you see the clauses, if you see the amendment, it is like the auditor has to work like an almighty. The auditor has to audit like the auditor should have a superficial power to see all these things, to see those transactions, even those which are not recorded in the books of accounts. How can an auditor comment on the unrecorded income? How can an auditor comment on the Benami property, right? How can an auditor comment on the capability of meeting the liabilities of the company? How can an auditor comment on the fraud? How can an auditor comment on the various aspects which is there in the CARO? Because it is the management who is conducting the business operations for this entire year, and it is the auditor who is spending some time within a year. For example, if you have an audit of a large listed company, probably you are spending 2 months or 3 months for audit of that client, right? If it is a small company, I mean to say, if it is a mid-level private limited company, probably you are spending 20 days, 25 days in the audit of that client, right? So from the auditor's lobby, there was an ask if there is an enhanced reporting requirement from the auditor perspective, there must be an enhanced disclosure requirement from the management perspective. And with this objective, on 24th March 2021, with this objective, on 24th March 2021, the new Schedule 3 got notified. I would not say there was an amendment. I would say it was a new Schedule 3 which was notified on 24th March 2021, right? If I talk about this new Schedule 3, the basic idea and objective of this new Schedule 3 is to cater the requirement which was there in the CARO, so that from the management side, management should come forward and management should make all these stringent disclosures in their notes to accounts, right? And when you look at the amendments to this Schedule 3, there is a separate section which talks about additional regulatory information, right? And this additional regulatory information, there are around 10 or 11 clauses which are new clauses which talks about this stringent kind of reporting from the management side, and of course from the auditor side. You are responsible for auditing and ensuring that whatever is reported by the management, that should be accurate, proper and correct, right? I hope I'm making sense to everyone. I hope we all are on the same page, right? Anilji, any question so far? Okay, let's move on. So with this objective, on 24th March 2021, this schedule 3 was notified, and we are talking about 25th February 2020 CARO, which is having 21 clauses, right? So we talked about 7 clauses exactly new, 7 clauses modified, and 7 clauses there is no change. Okay, so let's go back to the different slide once again. Let me go to my CARO slides. Yeah, so we'll discuss this. Now, coming to the fact that why there is a change in CARO. Why? This CARO was since 1988. Then it was 2003. Then it was 2015. Then it was 2016. Then it is 2020. Why? Why there is a change in CARO? The change in CARO was due to so many facts and so many aspects. So one of the main aspect is, of course, the fraud and scams which were happening. The second one is, of course, to ensure a better corporate governance, right? So when I say to ensure a better corporate governance, not in from the shoes of the management, but of course to comment on those corporate governances, right? So in the corporate domain, and you must have heard about that there were last minute auditor resignation were happening. Okay, so one auditor was appointed and the auditor was resigning. Okay, so there was a need to disclose this fact that why this auditor has been resigned, right? And from the auditor perspective, the incoming auditor or the signing auditor who is auditing the financial statement and commenting on the financial statement, he has to disclose this fact in the audit report, so that everyone would be able to know that yes, the auditor has been resigned, and whether the concerns or objections of the outgoing auditor were there, those have been addressed, right? Evergreening of loans. For example, the company has given me a loan and I'm not able to repay the loan, right? So bank will give me a fresh loan and I will repay the old loan and the new loan will start from the right now, right? So this evergreening of loans has started happening. I'll not take the name of the company, but you all are aware about that, right? Going concern issues. So probably the health of the company was looking a very sound and healthy, but suddenly 6 months after, or let's say 12 months down the line, this company become a sick company, or I would say there is a going concern issues happening with the company. So what went wrong in this small amount of time that the going concern issues have been arisen? And that is why a new clause has been inserted, right? When so I have talked about this last minute auditor resignation, there is a new clause. Going concern issues, there is a new clause which have been inserted, and now the auditor has to comment on the capability of the company, or ability of the company for meeting its liabilities, right? CSR. So everywhere you are hearing about ESG, sustainability, right? Environmental social governance, sustainability. The entire world is talking about these things. SEBI has notified BRSR, business responsibility and sustainability reporting, which is mandatory from the next year for the top 1,000 listed companies, and it was voluntary for 21-22, right? And CSR is one of the subdomain of this ESG, right? And you can see that there was a lot of new circulars, a lot of notification and changes in terms of CSR provisions, right? And that is why the responsibility is given to auditor also to comment on the CSR, that what is the fund which is lying with the company in terms of ongoing projects, in terms of non-ongoing projects, in terms of CSR, right? Strengthening of the role of internal auditor. If I talk about statutory auditor and internal auditor, right? So both have a different roles. Internal auditor is kind of a person who is working for the management, or I would say who is into the day-to-day auditing affairs with the management, right? So internal auditor talks more about the governance, talks more about the processes, SOPs, right. So internal auditor talks more about the risks, more about the leakages, right? So if internal audit is applicable to a company, so first of all, there was a clause in 2003 which talks about whether the internal audit system commensurate with the size and nature of the company, right? So now statutory auditor has to rely on the, or has to refer the internal audit report, and statutory auditor has to comment in its CARO that regarding this internal audit system of the company, regarding the internal audit of the company, right? So what happens if the internal audit is not applicable to the company as per section 138, which talks about 200 crores of turnover or 100 crores of borrowings or so? So the statutory auditor has to comment that the company does not have internal auditor or internal audit system. For example, the company does not have internal auditor because it is not applicable as per section 138 of Companies Act 2013. Right. Loans and advances to related parties. And I would say, if you talk about compliances and regarding the related parties, I would say it is highly focused and most ignored area. Just 10 days ago, I was reading in Economic Times regarding this related party disclosures of made by Reliance Industries, right? And there was a specific article which talks about the detailed disclosure or enhanced disclosure made by Reliance in their related party segment in their financial statements. So related party is one of the most easiest route, one of the most influential route where the company can plan a transaction, right? Because you can influence your own people, because related parties are something where you can influence, right? So related party transaction are those transactions which can be planned, okay? So now if a company is giving a loans and advance to related parties, so that has to be disclosed in compliance with section 177, 188, section 185, 186. These disclosures were there, but there are some enhanced disclosure regarding this related party as well. Whistleblower complaints and frauds, right? If you remember 3 years back, the employees of the Infosys has made a whistleblower complaint, right? So if there are some whistleblower complaint, if there are frauds, and as rightly mentioned by Sanjay Vasudeva ji, yes, the reporting of fraud has been enhanced. Earlier it was talking about employee and officer. Now this word employee or officer has been removed. So if there is a fraud due to third party, if there is a fraud due to vendor, if there are cyber frauds, so all these frauds will come into picture in terms of reporting as far as this CARO reporting is concerned, right? Responsibility on parent auditor in responsibility of parent auditor in case of some adverse remarks, not in subsidiaries, rather subsidiaries, associates, and joint venture. So if you look at clause 3, subclause 21, it says that if a company or an entity which is a part of the consolidated financial statement, right? For example, there is a company XYZ Limited and it's a parent company, and there is a qualification or there is a adverse remarks in CARO in its subsidiary or associate or joint venture, right? So as a group auditor, earlier this requirement was not there to capture if there is any adverse remarks in the CARO report of those entities, right? CARO report of those entities. Now, if I talk about a standalone account and a consolidated accounts, right? A standalone account is like a account of an individual company, account of an individual, financial statement of an individual. If I talk about consolidated financial statement, it is like a family accounts, right? It is like a family accounts. And I would relate this thing with a normal life, with in a very layman sense. For example, if there is a problem in an individual person, what would you say? You will say that this person is not good, right? You will comment on the character of that individual person. But if there is a person who is not having a good character, who is not good in a family, what would you say? You will say, na, that in this family, one of the person of this family is not good. So although you are also commenting on a family, I'm just talking from a very layman sense, in a very layman manner. So likewise, the responsibility on the group auditor has been enhanced. The CARO is not applicable on consolidated financial statement, but if there is any adverse remarks in all the 20 clauses, there are 21 clauses, but 21 clause talks about, the 21st clause talks about the adverse reporting in the parent consolidated financial statement report in case of if there is any adverse reporting in subsidiary, joint venture and associates, right? So these are the reasons why there is a change in CARO. So why this CARO 2020 is more stringent, more transparent, it has given more responsibility to the auditors, it has captured, you know, lot of compliances, and of course it is governed and it is guided or supported by the amendment in division 1, division 2, division 3 to schedule 3, wide MCA notification dated 24 March 2021, right? So friends, let me share one of the Word file which I have prepared or which I have compiled. I hope my Word file is visible. It would be great if any one of you can please confirm. Is it visible? Yeah. So friends, if I talk about clause 1, this clause 3 subclause 1 talks about property, plant and equipment, and now the reporting has been enhanced in terms of not only property, plant and equipment, even in terms of intangible asset as well. So you can see on the screen that whether the company is maintaining proper records showing full particulars of intangible asset, it has to be disclosed, it has to be reported in terms of CARO. Sorry, before taking this, let me take on the applicability part also, because one of the participant is asking for the applicability part as well. Let me take that quickly and then I'll shift on the requirement, shift on the new requirement under this CARO 2020. So CARO 2020, there is no change from the applicability perspective, right? So there is a change from the reportability perspective, but there is no change in the applicability perspective. So whatever applicability in CARO 2016 was there, the same applicability in CARO 2020 is also there. This CARO 2020 shall apply to every company, including a foreign company, as defined in section 2 subsection 42 of the Companies Act 2013, except CARO 2020 is not applicable to the banking company. CARO 2020 is not applicable to the insurance company. CARO 2020 is not applicable to the section 8 companies, right? CARO 2020 is not applicable to one-person company as defined under section 2 subsection 62 of the Companies Act. CARO 2020 is not applicable to small company as defined under section 2 subsection 85 of the Companies Act, right? And CARO 2020 is also not applicable to private limited company, which is not a subsidiary or holding of a public company. For example, XYZ Private Limited is a holding company of XYZ Limited, right? And XYZ Limited is a public limited company. When I say public company, it does not mean it's a listed company, right? So if XYZ Limited is a public company and XYZ Private Limited is a holding of this public company, then on XYZ Private Limited, CARO is applicable. You are not required to see the threshold from this perspective, okay? Or vice versa, if XYZ Private Limited is a subsidiary of XYZ Limited, then CARO will be applicable on this entity, right? So on private limited company, CARO 2020 will not be applicable if this company is having a paid up share capital and reserves and surplus for not more than 1 crore as on balance sheet date, and the or is not there, and so first clause, first condition कि पेड अप कैपिटल और रिजर्व्स एंड सरप्लस 1 करोड़ से ज्यादा का नहीं होना चाहिए बैलेंस शीट डेट पे. Total borrowings should not exceed 1 crore from any bank or financial institution at any point of time during the financial year, right? During the point of time, at any point of time during the financial year. तो आपको बैलेंस शीट डेट पे नहीं देखना है. Total borrowing should not exceed 1 crore at any point of time as Sanjay Vasudeva ji has correctly mentioned, that this CARO is for the full year, not only on the balance sheet date, right? Not only on the reporting date. So you have to see the borrowings from the entire year perspective, not only from the balance sheet date perspective, right? And which does not have a total revenue as disclosed in Schedule 3 to the Companies Act 2013, including revenue from discontinued operation. And what is meant by total revenue? So total revenue means total income, revenue plus other income, right? So if the total revenue as disclosed in Schedule 3 to the Companies Act, जो आपने अपने P&L में disclose करा है, if the total revenue does not exceed 10 crore, does not exceed 10 crore during the financial year, अगर ये तीन कंडीशन फुलफिल होती हैं कि पेड अप कैपिटल रिजर्व 1 करोड़ से ज्यादा ना हो, आपकी बोरोइंग्स 1 करोड़ से ज्यादा ना हो और 10 करोड़ से ज्यादा की टर्नओवर ना हो और वो प्राइवेट लिमिटेड कंपनी हो, तो उस पे कारो अप्लाई नहीं होगा. नाउ माय क्वेश्चन टू यू गाइस इज whether preference share capital will be covered under paid up capital. Answer is yes. In reserves and surplus, whether capital reserve will be covered or only revenue reserve will be covered. So both capital reserve as well as revenue reserve will be covered, right? If there is a negative balance in surplus, if there is a accumulated losses, then this accumulated losses will be deducted, right? Second question, if a company is having a loan from State Bank of India, if there is a private limited company, the loan from SBI is, for example, 75 crores, right? And there is a loan from HDFC Limited, it is a NBFC, it is an NBFC. For example, it is 20 crores, right? And there is a loan from director, there is a loan from director, loan from director. It is less than, it is, let's say, 10 crore. Now tell me whether on this company CARO will be applicable. The total borrowing is 1 crore and sorry, it is not 75 crore, it is 75 lakhs. Sorry, 75 lakhs, 75 lakhs and 10 lakhs. Now tell me the total borrowing is 1 crore 5 lakh. Whether CARO will be applicable to this company? Answer is no. Why? It talks about loans and borrowings, the total borrowings from any bank or financial institution. It is not talking about loan from director. So it is 95 lakh only, right? And hence CARO will not be applicable. The small company and section, small company and 1% company has already exempted, right? So if a company is covered under the definition of small company, and what is the definition of small company? Let me tell you, the definition of small company has been changed with effect from 1st April 2021. With effect from 1st April 2021, the definition of small company has been changed. And where it has been changed? So the MCA has notified an amendment in the company's specification of definition details rule to 2014, right? The company has changed this definition in company's specification of definition detail rule 2014, and the company and MCA has changed the limits for describing a company as a small company. Earlier, if a company was having a paid up capital of 50 lakh and turnover of 2 crore is considered as a small company. Now this 50 lakh has been moved to 2 crores. So now for definition of a small company is, the definition of small company is the company which is having a paid up capital. Please mind my word, paid up capital and reserve and surplus nahi, ye paid up capital hai. The paid up capital of rupees 2 crore and turnover of rupees 20 crore will be considered as a small company. If a company has been classified as a small company, then there is no need to check the criteria of private limited company, whether these companies having such threshold or not, right? So this order is, this CARO, company's auditor's report order, is not applicable on consolidated financial statement except on consolidated financial statement except para 3 subclause clause 3 subclause 21, right? Subclause 21. I hope it is clear to everyone. I hope so it is clear to everyone. Yeah, there are some important points which I want to highlight, because I have seen that on these points there are some mistakes which is unintentionally done by the auditors or chartered accountants. So paid up capital includes equity as well as preference share. amount originally paid up on forfeited share should be added to the figure of paid up capital, right? Share application money, if there is a share application money, this share application money should not be considered as a part of paid up capital, right? Reserves includes capital reserve, revenue reserve, as well as revaluation reserve. If there is a credit balance of P&L, of course it will form part of reserve. If there is a debit balance of P&L, it will be netted off from computing reserves and surplus. Loans from banks and financial institutions are to be considered in aggregate, right? And this financial institution will include NBFC. You will not include loan from director or let's say from employee or from other party, right? Loans could be term loan, demand loan, cash credit, export credit bill, purchased or discounted, right? Long-term loans as well as short-term loans, secured as well as unsecured. All these loans have to be considered for checking the applicability of CARO. Outstanding dues in respect of credit cards will also be considered. Interest accrued as well as dues form part of outstanding loan, whereas interest accrued but not due is not considered as a loan, right? So it's not only a loan. If there is an interest accrued as well as due, it will also form part of your outstanding loans and borrowings. Total revenue is disclosed in Schedule 3. It comprises of revenue from operations as well as other income, right? So we have discussed this aspect. Now let's move on quickly on the CARO clauses, and I'll also discuss Companies Act Schedule 3 with this CARO. So in clause 3, subclause 1, in property, plant and equipment, intangible asset have also been inserted, right? Regarding the title deed of immovable property, so I am talking about the right side. You can see the screen. In my screen on the left side, CARO 2016 is there. In right side, 2020 is there, and there is on the extreme right there is a column which talks about the nature of the change, right? So in the red part, it is a changed clause, right? So whether the title deeds of all the immovable properties disclosed in the financial statement are held in the name of the company, if not, provide the details thereof, right? So in this clause, one clause has been inserted. In this clause has been modified. This subclause has been modified, and other than properties where the company is the lessee and the lease agreements are duly executed in favor of the lessee. What does it mean? So for example, if a company has taken an immovable property on lease basis, right? On a lease basis, and the title deed is not in the name of that company. When I say title deed, so Institute has also issued a guidance note which talks about a registered lease deed. Title deed includes registered lease deed, conveyance deed, right? Ownership papers, right? So any document which gives you a sense of ownership kind of thing, right? So if there is an immovable property which is leasehold immovable property and the lease agreement is not executed in the name of the company, that kind of disclosure will also be required in this particular subclause, right? And to support this, there is an amendment in Schedule 3 as well, in Division 1, 2, 3 of Schedule 3, which says that if a company is having an immovable property where the title deed is not in the name of the company, then management has to make a disclosure in the notes to account. और उस disclosure में क्या देना है? Particulars, land है या building है या land और building है, right? Then after particulars, then you have to state the title, or let's say the line items where these items have been stated in the balance sheet. Then these title deed is in the name of whom? Director, promoter, or relative of director, or relative of promoter, right? What is the gross carrying value of these immovable properties? Since when these immovable properties are not in the name of the company, and since when the company is holding this? The last one is why it has not been registered in the name of the company, right? So this is the amendment in the Schedule 3. This is the amendment in the Schedule 3, and I'll show you one of the disclosure which is made by Tata Steel. Very good disclosure in terms of this title deed thing. So this is the disclosure. The title deed of all the immovable property other than properties where the company is the lessee and the lease agreements are duly executed in favor of the lessee are held in the name of the company except for the following, right? So here description of the property is there. Here gross carrying value is there, held in the name of, for example, Bhushan Steel Limited. So Tata Steel has acquired Bhushan Steel, right? So whether this property is in the name of director, promoter, or relative? No. Since when it is held by the company? April 2020. What is the reason? For certain properties acquired through amalgamation merger, the name change in the name of the company is pending, right? So this is a disclosure in the Tata Steel. So this disclosure is required if the company has revalued its property, plant, and equipment, right? Right of use assets or intangible asset during the year, and if there is a change of 10% or more in the net carrying value of each class of PPE or intangible asset, then this thing has to be disclosed in the CARO report of the auditors, right? Now the question comes, the same disclosure is there in schedule 3 as well. Same disclosure is there, right? But accounting standard 10 and Ind AS 16 says that if there is a revaluation surplus, or if there is a if there is a revaluation which the company is carrying for the class of assets or class of PPE, that revaluation has to be disclosed irrespective of the materiality or irrespective of the threshold, right? So as an auditor, as far as CARO is concerned, you have to report where it is more than 10%. But as an auditor, you need to see the compliance of accounting standard or Ind AS as well, right? So if there is a revaluation, it has to be disclosed irrespective of the limit. Another one is whether any proceedings have been initiated or are pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988 and rules made thereunder. If so, whether the company has appropriately disclosed the details in the financial statement. So see, the reference is in the disclosure in the financial statement. So in this case, Schedule 3 has also been amended, and the management has to make an appropriate disclosure in the Schedule 3 in the notes to accounts of the financial statement, and auditor has to talk about if there is any proceeding which have been initiated or pending, right? So auditor has to give the disclosure for that. And in the CARO report, auditor has to mention the para number in the notes to accounts to give a reference to the notes to the financial statement, right? Coming to the clause 2, where it talks about the inventory. Earlier the word use was whether physical verification of inventory was conducted by the management and whether any material discrepancies were noticed. The word use was material. Now this material has been replaced with 10%. If the discrepancies is 10% or more in aggregate of each class of inventory, for each class of inventory. For example, there are 3 godowns, and in one godown there were 20% discrepancy, and in the 2 godowns there are 5% discrepancy, and in total it is 8% of the in aggregate by class of inventory. Whether it is required to be disclosed, answer is no, right? So in this para, auditor has to specifically comment on the coverage and procedure adopted for physical verification of inventory also, right? And I have said that materiality has been defined as 10% or more in each class of inventory on an aggregate basis, right? There is one more clause which have been added in this clause 2. One sub clause have been added. Whether during any point of time of the year the company has been sanctioned working capital limit in excess of 5 crores or more. Please mind this particular clause. It is talking about word sanction, not availed. So if a company has been sanctioned 5 crore rupees or more of working capital limit during the year in aggregate from banks or financial institution on the basis of the security of current assets, then being an auditor, you have to report whether the quarterly returns or statement filed by the company with such bank or financial institution are in agreement with the books of accounts of the company. If not, give the details. Now the first question arises, sir, we are the auditor of a private limited company, and the quarterly DP statement and quarterly the stock statement, debtor, creditor, this has to be filed on a quarterly basis. And we are just we are going to the client's place after completion of an year or at the end of the year. So how can we verify that? Now the first thing is, if you have a closing balance of the year end, you have to do the backward reconciliation with the help of sales and purchases data. That is the first thing. The second thing, being an auditor of the private limited companies, you have to exercise more diligence, right? Now you have to call to the client and you have to ask for what data they have submitted to the bank on a quarterly basis. And you can also ask for the records, the accounting records on a quarterly basis. For example, tally data, you can ask on a quarterly basis so that the backdated entries cannot be posted on that. And even as per standard on auditing, you can call for external confirmations. You can get the confirmation from banks, or you can get these statements which is filed by the client to the banks. You can directly approach to banks and got those confirmations, right? So this is a new subclause added. And let me talk about the schedule 3. In schedule 3, it talks about the overall borrowings without any threshold, right? Management has to do more extensive disclosure. So as per schedule 3, management has to disclose if management has taken a loan, has taken a working capital in excess of 5 crore without any threshold. For example, 10 rupee of loan, right, on the basis of security of current asset. So management has to disclose in the notes to accounts that the quarterly returns are matching with the accounting records maintaining in the books of accounts, right? So clause number 3, which talks about investment loans, guarantees, security, this clause has been elaborated. Earlier, the clause was talking about loans, right? Now this clause is talking about the investment, guarantee, loans, security, everything, right? So whether during the year the company has provided loans or provided advances in the nature of loan, अगर कंपनी ने लोन प्रोवाइड किया, एडवांस इन द नेचर ऑफ लोन प्रोवाइड किया है, या गारंटी दी है या सिक्योरिटी दी है टू एनी अदर एंटिटी, अगर किसी भी एंटिटी को, प्रोवाइडेड ये एंटिटी लोन देने के बिजनेस में नहीं होनी चाहिए, तो आपको क्या रिपोर्ट करना? यू हैव टू रिपोर्ट नेम ऑफ द एंटिटी, यू हैव टू रिपोर्ट एग्रीगेट अमाउंट ड्यूरिंग द ईयर, एंड यू हैव टू रिपोर्ट आउटस्टैंडिंग बैलेंस. If it is to subsidiary, joint venture and associates, you have to disclose the name of those subsidiary, joint venture and associate. If it is to other than subsidiary, joint venture and associate, then you have to report the name of those companies or entities other than subsidiary, joint venture and associates, right? So you have to disclose, right? Now coming to the evergreening of loan. If any loan or advance in the nature of loan has been given, right, which has been fallen due during the year, but either it has been renewed or extended, or fresh loan has been given to settle the overdue loan to the same party, right? If this is the case, then as an auditor, you have to report, you have to specify the aggregate amount of such old loan which is renewed or extended or settled by the fresh loan, and the percentage of such loan to the total loans and advances, right? If the company has given a loan to any relative or to related parties under section 2 clause 76 of the Companies Act 2013, अगर कंपनी ने सेक्शन 2 क्लॉज 76 की किसी पार्टी को लोन दिया है, फर्स्ट इफ इट इज रीपेबल ऑन डिमांड, कि जब हम आपसे मांगेंगे आप मुझे वापस दे देना, और विदाउट स्पेसिफाइंग एनी टर्म्स एंड कंडीशन. If this is the case, then as per revised schedule 3, management has to disclose this fact, name of the party, amount given during the year, amount outstanding during the year, right? And being an auditor, you have to comment on this thing, right? Clause number 4, it talks about section 185, 186, there is no change. Clause number 5, there is no much change, deemed deposit have been covered here. Clause number 6, there is no change, maintenance of cost records is there, so you have to comment on that. Clause number 7, A and B, there is no change. Clause number 7A talks about if the company is regular in depositing the undisputed statutory dues. If not, and it is beyond 6 months from the end of the financial year, you have to report as an auditor in the CARO. And if there are disputed statutory dues, in that case, you have to disclose the amount involved and the forum where the dispute is pending, right? Now coming to the first clause, which is a new clause, clause number 8. And clause number 8 has been inserted in CARO 2020 and has been inserted in revised schedule 3 as well, right? And what is this? It says that whether any transaction not recorded in the books of account have been surrendered or disclosed as income during the year in the tax assessments under the Income Tax Act 1961. If so, whether the previously unrecorded income has been properly recorded in the books of accounts during the year. As rightly mentioned by Sanjay Vasudeva ji, that yes, this clause has a accounting implications also. If a company is into accounting standard, so AS5 talks about disclosure of this item as a prior period item. But if the company is following Ind AS, so Ind AS 8 read with Ind AS 1 talks about restatement of previous year financial statement and giving the third balance sheet if error pertains to, if this error or mistake pertains to the period beyond the comparative year, right? And please mind my word, lot of people are asking, sir, if there is a undisclosed income found in GST, whether it has to be disclosed. The answer is no, because the word used is under the Income Tax Act 1961, right? So there is a raid in the premises of the company, and during the raid, some undisclosed cash has been revealed, right? Some undisclosed income has been identified, or during the assessment, the assessing officer has found some undisclosed income, right? So these kind of things have been disclosed here. If the assessing officer has disallowed certain expenses, whether it will be covered here, answer is no, it will not be covered here, right? Clause number 9, and I have talked about this clause number 8. There is same disclosure requirement in the notes to accounts by the management side. In clause number 9, it talks about the default in the repayment of loans and borrowings, right? It talks about the default in the repayment of loans and the borrowings. And earlier it was talking about the financial institution, banks or government. Now it is talking about the lender. So the lender could be the bank, could be any other party, right? It could be any other party. And there is one more clause, there is one more sub clause which has been added here, and that clause is willful defaulter. If the company is declared as a willful defaulter by any bank or financial institution or other lender, so this requirement is also there in Schedule 3, new Schedule 3, and this requirement is also there in the CARO 2020, right? If a fund raised on the short-term basis, the working capital loan has been taken and fixed asset have been acquired with this working capital loan, right? So again, this is required to be disclosed in the CARO as well as Schedule 3, right? So these things are required to be disclosed in this CARO 2020. Clause number 10 talks about the money raised by way of initial public offer, further public offer, right? Or preferential allotment or private placement. It caters the same thing. Earlier, the word term loan was there. So the term loan has been removed and the term loan has been covered in the para number 9. Okay. So para number 10, there is no much change. Para number 11. So para number 11 earlier was talking about whether any fraud by the company or any fraud on the company, by the company, on the company. ठीक है, कंपनी ने फ्रॉड किया, कंपनी पे फ्रॉड हुआ, by its officer or employee has been noticed or reported during the year. If yes, the nature and amount involved to be indicated. This is the older version. What is the newer version? The newer version is the word officer or employee have been removed. Whether any fraud by the company or any fraud on the company has been noticed or reported during the year. If yes, the nature and amount involved is to be indicated. The banker, the company was having a dormant account, and the banker has made a fraud with that account, right? Whether that fraud has to be disclosed, answer is yes, that has to be disclosed, right? Whether any report, new sub clause has been inserted, and regarding this clause 11, there is no requirement in Schedule 3, right? Whether any report under subsection 12 of subsection 143 of Companies Act has been filed by the auditor in form ADT 4 as prescribed under Rule 13 of Companies Audit and Auditor Rules 2014 with the central government. If the auditor has filed any report with the central government under section 143 subsection 12, so that is also required to be disclosed. If the auditor has considered any whistleblower complaints, if any received during the year by the company, then it is also required to be disclosed. Earlier clause 11, which was talking about managerial remuneration, has already been deleted. Now clause 12 talks about the Nidhi company, and this is the same requirement. There is no change. It talks about Nidhi company compliance, right? So there is only one new subclause added, which talks about whether there has been any default in payment of interest on deposits or repayment thereof for any period, and if so, details thereof. So only the detail of default is there. Otherwise, there is no change. Coming to clause number 13, there is no change. Clause number 13 talks about whether all transactions with the related parties are in compliance with the section 177 and section 188 of the Companies Act, where applicable, and the details have been disclosed in the financial statements, etc., as required by the applicable accounting standard. And what are the applicable accounting standard? If it is following AS, then AS 18. If it is following Ind AS, then Ind AS 24. Right, Ind AS 24. So if it is a listed company and the company has made a non-compliance with the SEBI LODR regulation 23, then what will happen? To my mind, although it is not written here, to my mind, that is also required to be disclosed. Right. Clause number 14. Clause number 14 is a new clause, and it talks about whether the company has an internal audit system commensurate with the size and nature of the business, and whether the report of the internal auditor for the period under audit were considered by the statutory auditor. If on any company internal auditor appointment is not mandatory, the statutory auditor has to mention this fact that as per the provisions of the Companies Act, on this company internal audit is not mandatory, and hence we are hence this clause is not applicable. Right. Clause number 15 was regarding non-cash transaction with directors, and it is the same clause which is there. There is no change in clause number 15. Coming to the clause number 16, the clause number 16 talks about the registration with RBI in terms of section 45 IA of the RBI Act 1934, right? And in this clause number 16, there are some new sub clauses which there. For example, if the company has conducted any NBFC, non-banking financial, of housing finance activity, right, without a valid certificate of registration. If a company is into NBFC activity without having a valid certificate of registration from RBI, this is required to be disclosed, right? So what is meant by without valid certificate of registration? For example, the company has applied for the certificate, but the company has not received the certificate, right? The company has not received the certificate. Probably this could be the WIP scenario, work in progress scenario, right? If the company is a core investment company, as defined in the regulation made by the RBI, if so, whether it continues to fulfill the criteria of a CIC, and in case the company is an exempted or unregistered CIC, whether it continues to fulfill such criteria, it is also required to be disclosed. Whether the group has more than one CIC as part of the group. So if there is a company and in the group, upside is there and downside is there. So if there is more than one CIC in the group, in that case, being an auditor, you are required to report that how many number of CICs are there which are part of the group. And how auditor will ensure? For example, in my company, auditor has taken this confirmation from the holding company, from the promoter group, and from the downside companies, right? So you need to disclose you are not required to disclose the name of the CIC. You are required to disclose the number of CICs. Coming to clause number 17 to clause number 21, these all are newly inserted clause, completely newly inserted clause. Right? Clause number 17 talks about whether the company has incurred cash losses in the financial year and in the immediately preceding financial year. If so, state the amount of cash losses. First of all, what is meant by cash loss? For example, in profit before tax, you will add back or you will adjust non-cash item. You will get a cash losses, right? And this cash losses could be in the cash flow from operating activities, cash flow from investing activities, cash flow from financing activity. So in my view, if there is a cash loss from operation, if there is a cash loss from investing, cash loss from financing, these all are required to be disclosed. Now, one of the participant was asking, sir, if there is a incurred cash losses in the preceding financial year but not in the current financial year, whether it is required to be disclosed. To my view, in my view, yes, it is required to be disclosed, right? Then clause number 18, again a completely new clause, right? Whether there have been any resignation of the statutory auditors during the year. If so, whether the auditor has taken into consideration the issues, objection, or concerns raised by the outgoing auditors, right? So it's not like that company, that auditing firm has moved out and you as a new auditing firm has just joined and you are very happy, right, that I got this client, I got this group, but you have to make a compliance also, right? So you have to report that what were the issues, what were the objection, what were the concerns raised by the outgoing auditors, right? Clause number 19 is a very stringent clause. And as far as this clause is concerned, there are a lot of amendment, lot of changes in the Schedule 3 also. This clause says that on the basis of the financial ratios, on the basis of the financial ratios, when I say financial ratios, in Schedule 3, Division 1, 2, 3, not Division 3, Division 1, 2, there are 11 ratios which have been given as an amendment to the Schedule 3. So on the basis of financial ratios, aging, when you see the revised requirement of Schedule 3, it talks about giving the trade receivable aging, right? Disputed, undisputed, up to 6 months, 6 months to 1 year, 1 to 2 year, 2 to 3 year, more than 3 year, you are required to disclose the aging of trade receivables. You are required to disclose the aging of trade payable. Up to 1 year, 1 to 2 year, 2 to 3 year, more than 3 year, MSME, non-MSME, disputed, undisputed, right? For example, being an auditor, if there is an MSME and the outstanding is for more than 1 year, because the slab is less than 1 year, more than 1 year, right? So you have to ask the management that whether the disclosure requirement under section 22 of MSME Act is matching with this disclosure, whether it is matching with the MSME return which you are filing on the half yearly basis, whether the proper interest provisioning has been done in the books of accounts, right? So these all questions you need to ask. CWIP, if there is a suspended CWIP, if there is a project in progress, then what is the aging? Why this CWIP has not been capitalized, right? Probably the management don't want to capitalize the CWIP because as per accounting standard and Ind AS, depreciation start when the asset is available for use. If the management will capitalize the CWIP, probably the management has to put the depreciation in its P&L account. Probably the management don't want to put any expenses in the current year, and that is why they don't want to capitalize this CWIP. So all these sort of questions you need to ask after looking at financial ratio, aging, and expected date of realization of financial assets and payment of financial liability. And this disclosure is required as per Ind AS 107 also, right? Other information accompanying the financial statement, for example, board report, and it is requirement of the standard on auditing also. The auditor knowledge of the board and management plan, whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that company is capable of meeting its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. Now the question arises, please read this clause number 19 carefully. This clause number 19 talks about whether the auditor is of the opinion after looking at the ratio, after looking at the aging, after looking at the expected date of realization, after looking at the other information, after having a knowledge of the board and management plan, whether the auditor is of the opinion that no material uncertainty exists, not on the date of balance sheet, on the date of audit report. For example, for the private limited companies, you are signing the audit report on, let's say, 25th of August. So you have to look on the 25th of August, right? So it is like a subsequent event, and a standard on auditing is also there, which talks about taking the cognizance of subsequent event by the auditors in their audit report, right? Clause number 20 talks about the CSR thing, and it says that if there is a other than ongoing project, right, then the company, whether the company has transferred unspent amount to a fund specified in Schedule 7 to the Companies Act within a period of 6 months of the expiry of the financial year. So auditor has to comment if there is a non-ongoing project, then company has to deposit the money into a special bank account within 6 months from the end of the financial year. So what will you do if you are signing an audit report on 31st May and 6-month period has not been expired? In that case, you have to disclose this fact, right, that the time period has not been expired. But if any amount remaining unspent, relating to any ongoing project, in case of an ongoing project, as per section 135 subsection 5, it says that management, for example, the project has been started in the current year, so in current year plus 3 years, so 3-year time has been given for the completion of CSR project. But if in case of an ongoing project, the project has not been completed, so whether the money has been deposited in a special account in compliance with the provision of subsection 6 of section 135 of Companies Act is required to be disclosed by the auditors, right? Clause number 21, as I have mentioned earlier also, that the parent auditor responsibility has been enhanced on the family accounts, on the consolidated accounts, to report if there is any adverse remarks in subsidiary, joint venture and associate, and that is getting consolidated. So in that case, those adverse remarks has to be reported in the consolidated financial statement as well. So in the consolidated financial statement, this entire 21 clauses CARO report is not required to be disclosed or to be printed. Only the relevant clause, if there is any adverse remark, only those clause is required to be reported in the CFS. Otherwise, it is not required to be reported. So I have covered my my presentation, and so Anilji, over to you. If you guys have any question, so I would be happy to answer to the extent I would be able to answer.
Thank you, sir. Thank you so much for such a detailed and deliberation in a very lucid manner. You have covered all the aspects, and it was really nice to have you today, sir. I have received certain questions. If you allow, can I raise the question, sir?
Yeah, sure.
Sir, first question is, can an auditor resign without issuing any report, or is it compulsory for the auditor to issue the report first before resigning?
So in my view, of course, when the auditor is going to be resigned, so probably he has to issue the report till the time he has served to that client. So probably the auditor has to issue a report, and auditor has to communicate or share this report with the incoming auditor as well.
To the new incoming auditor? Yes, sir. And whether whistleblower complaints reported in CARO are to be reported separately to SEBI as well as the company law board?
So yes, if you see, if I correctly recall and correctly remember, there was a whistleblower complaint by the Infosys employees, and I don't remember the exact regulation of SEBI LODR, but yes, this is required to report to SEBI as well. And this Infosys whistleblower complaint was reported to SEBI.
Yes, sir. So sometimes it is very difficult to find out the issues or concern raised by the previous auditor. So how to know about the concerns raised by the previous auditor? Shall incoming auditor write to the previous auditor?
So of course, you need to speak to that outgoing auditors, and of course, it should be a kind of a formal thing. It should not be a verbal in a verbal manner. He has to write. For example, the issue or concerns could be, he can say that the client is not giving a correct data. Second, he could say that the client is has involved in some malpractices. He can say that the client is not ready to do the compliances. Okay. So there could be some situations where the outgoing auditor has to, report that what are the issues and why he is leaving that client. So I believe it has to be in a written manner.
Yes, sir. And if there is any no Benami property transaction, does it is required to disclose in financial statement as per the Schedule 3, saying that there is no such transaction?
So if something which is not applicable, this is not required to be disclosed on a mandatory basis. There are some companies, and I was looking I was looking on the financial statement of Sri Ram Transport Finance Company Limited. It's a listed company, and that is why I can quote the name also, right? So they have reported that this clause is not applicable to the company, although this is a new amendment, but this clause is not applicable. But as far as law is concerned, it is not mandatory to disclose that it is not applicable. Then why only Schedule 3? Why not all the accounting standard? For example, if there are 27 accounting standard and there are 39 Ind AS, and every accounting standard and every Ind AS is not applicable to a company, then why not to disclose that this standard is not applicable, that standard is not applicable, SEBI LODR is not applicable, right? So it is not mandatory in my view.
Yes, sir. Sir, CSR provision is first time applicable to a private limited company in the financial year 2022-23. Since net profit exceeds ₹5 crores in the financial year 21-22, till what time company has to make the expenditure towards CSR?
So first of all, for example, in 22-23, when you are looking at 22, 23, you need to see the eligibility criteria, right? If it is following the eligibility criteria, then you need to calculate the threshold, 3%, 2% of average net profit, right? So in 22, 23, that money has to be invested till 31st March 23. If it is relating to the non-ongoing project, right? In that case, you have to either you have to spend or you have to open a special bank account. You can deposit within 6 months from the end of the financial year, and then you can invest, or you can spend in the next year itself, right? And if it is relating to ongoing project, then you have to spend the money within 3 years from the current financial year. And if it has not been spent within 3 years, then you have to deposit in the special fund within 30 days from elapse of the 3 years, right? From lapse of this 3 years. So this is what I can answer to this question.
Yes, sir. Sir, apart from the sale deed, what is the defining document to establish title to the immovable property?
Apart from the sale deed, it could be conveyance deed, it could be a registered lease agreement, right? It could be conveyance deed, it could be your registration certificate, like registration papers, which I say registry, right? Or it could be registered lease agreement. These can be considered, and even in guidance note issued by AASB, they have also taken the example of these things. Yeah.
So last question is statutory auditor for the financial year 21-22 has resigned in the financial year 22-23, and new auditor has been appointed in EGOM for the year financial year 21-22. Whether such resignation is required to be considered for clause purpose, since resignation was not made during financial year 21-22?
See,
as per clause 16.
When we are preparing the financial statement, so for example, FY 21-22 is the year when management will prepare the financial statement, right? So financial statement has to be prepared for the year ending and as at 31st March, for the year ended and as at 31st March 22. And then comes the role of the auditor, right? So you will audit the financial statement when the financial statement will get prepared, right? So financial statement will be prepared till 31st March 22. And when the auditor was supposed to come for the audit, then he resigned, right? So in that case, although he has not resigned during the previous year, but he has resigned after the completion of this year, but before conducting the audit, right? So you have to make the constructive or harmonious definition of this particular clause. And in my view, if the auditor has been resigned before signing of the financial statement, you have to report this as per the clause 16 as per clause 16 of para 3 of CARO report.
Sir, if time permit, can I take one more question? Last question, sir.
Yeah.
Yes. Quickly, sir. We are required to comment on the quarterly returns and statements filed by the company with such banks or financial institutions are in agreement with the books of accounts of the company of the respective quarters. Are we required to comment on all deviations or only adverse deviation, such as lower inventory, books, debts, then stated in the statement?
See, if you will see the clause, so the clause talks about the deviations, right? The clause talks about the deviation. The clause does not talks about the kind of the deviation, right? Which kind of deviation you are having. So in my view, so whatever deviations are there, you are required to disclose those deviations. And if you see the clause, it clearly says that whether the quarterly returns or statement filed by the company with such banks or financial institutions are in agreement with the books of accounts of the company or not. If not, you have to give the details, right? First, you have to comment. For example, there is a favorable thing, right? For example, there is a favorable disclosure. Yes, the quarterly returns are in compliance or in line with the books of accounts, right? If it is not in line with the books of accounts, then you have to disclose that what is not in the line of the books of accounts. Is it Q1, Q2, Q3, Q4? What kind of anomalies are there? What kind of deviation is there? Till which extent? What is the amount of stock which is lying in the books? What is the amount of stock which is going to be reported? So this entire details has to be disclosed in the CARO report.
So thank you so much, sir. for sparing your valuable time and acceding to our request on a very shorter notice. On behalf of AASB of ICI, I extend my heartiest thanks towards you, as well as our today's keynote speaker, CA Sanjay Vasudevaji, our past Central Council member, for sparing their valuable time. Thank you so much, sir. Thank you so much for such a detailed and in a very lucid manner, with the full of examples. Thank you so much, sir. Thank you so much.
Thank you, Anilji, for the opportunity, and thank you, Sanjay sir, for joining this session and giving your guiding remarks. Thank you.
Thank you, sir. Thank you. Thank you. Namaste.